Greetings again, traders, and welcome back. Today, we are going to look at the seed category of the institutional reference point, which is the rejection block. We have already studied the others. Okay, what is a rejection block? Rejection blocks simply are formed at key turning points. When you look at where price is turning, there is a high possibility that you are going to spot a rejection block. Now, how do you spot a rejection block? You see, when price is about to change its course or move in the opposite direction, there is always the possibility that you are going to see candles like this, candles that have very long tails, or candles that have very long wicks. Okay, these are rejection blocks, and they are formed in between two other candles. Therefore, there has to be 3 candle price action. This is the first candle, this is the second candle, and this is the third candle. Now, the middle candle that has the longest tail is the rejection block. In this case, this is the bullish rejection block. Okay, 1 2 3. The candle in the middle with the longest tail is the rejection block. Okay, now in a bearish scenario, we want to look at the candle that has the longest wick. Okay, this is a wick of the candle and this is the tail of the candle. Now it forms in between 2 other candles, therefore it has to be 3 candles stick price action. So we have 1 2 and 3. Now the middle candle with the longest wick, that is your rejection block. Now you may be wondering, how is this significant even? Okay, the point is, IPTA, which is the interbank price delivery algorithm, always regards wicks as what? As imbalances. It considers wicks the same as gaps, as fair value gaps, as breakaway gaps, as measuring gaps, as new day opening gaps, as new week opening gaps, or simply vacuum blocks, or any form of gap, volume imbalances. That is how IPTA looks at wicks. Okay, so to IPTA, this wick is considered a gap. Therefore, IPTA is always going to trade back into this wick to offer fair value price. Remember, we said gaps are areas where areas of inefficient price delivery, and we always anticipate that what IPTA is going to trade back into those areas to offer fair value price for efficiency purposes. Okay, now when you measure a gap like this, the midpoint also is called what? The consequence encroachment. Remember, I said the midpoint of a gap is called a consequence encroachment. The midpoint of a rejection blocks wick also is called what? A consequence encroachment. We also have the upper quadrant over here, and we have the lower quadrant, which are also very sensitive areas in a rejection block. Now, for the bearish scenario as well, we are going to measure the rejection block like so, and anytime price returns to this rejection block, there's always a possibility that you are going to expect a reaction from there. Why? Because IPTA is considering this rejection block or this wick as what? As a gap. Okay, and the midpoint of this wick also is what is called the consequence encroachment. So if price ever trades back to this wick like this, we are expecting some form of reaction, especially at the consequence encroachment. We can be looking for sell opportunities here. Okay, in a bearish scenario. Likewise, in a bullish scenario, if price ever returns to especially the consequence encroachment, and usually even the high, okay, the high of this week, you can see some form of reaction from here, and you can be buying into that. So that is simply the significance of a rejection block. Okay, now like I said, they are formed at key turning points in the market, especially when the market is about to reverse. Okay, now we are going to go to the chart and we are going to see if we can spot rejection blocks, especially at key turning points. Let us look at GBP USD at the time of recording. This is a live market. Now look at this guy here. Look at this 3 candlestick price action. You have 1 2 and 3. Okay, let me zoom out so that you can see properly what I'm saying. We have this candle over here, this one candle, this second candle, and this other one. You see, this third candle that has the longest wick or the longest tail is a rejection block. So we are going to pay attention to this rejection block here, because it is possible that what IPTA is always going to refer to that level. And just to mention, it becomes very significant, especially when it has taken stops, okay, especially what sell side liquidity in a sell scenario or buy side liquidity in a buy scenario. Okay, that is when it becomes very valid. Also, it means it has to run on liquidity. Remember, below all lows is what is sell side liquidity, and above all highs is buy side liquidity. So that is a rejection block over there. Okay, a bullish rejection block in this scenario. Look at this one also. 1, 2, 3. This candle that has the longest wick here, irrespective of the color, is a rejection block. Now study how IPTA came back to this rejection block here and then took off. I hope you understand what I mean. Study how IPTA traded back here. Okay, it consider this guy as what, as a gap, and then when IPTA returns here in a bullish scenario, look at how it traded the consequent encroachment, and then it took off from here. Okay, so it is very important. Now let us continue again and see if we can spot any other one. I mean, we are going to see them especially at key turning points. Okay, look at this guy over here, this guy here. This is a rejection block here. This is a rejection block. Now look at this one. This is a rejection block 1, 2 and 3. Okay, and it has taken liquidity below these lows here. All of these lows here, it has taken liquidity below them. 1, 2 and 3. This middle candle with the longest wick is a bullish rejection block. Okay, and we are anticipating that next time when IPTA comes back there, we want to see some form of reaction. Now even if you study the high of this candle, this bullish candle, look at how IPTA just traded into the upper quadrant of this rejection block, the upper quadrant over here, and then it never came below, and the body of the candle stayed at the open of that rejection block. And what happened? You saw price moved aggressively upward. So rejection blocks are also considered as gaps. Okay, very sensitive areas. And what did we say? It has to take liquidity below an old low or above an old high. Now this is another rejection block 1, 2, 3. The middle candle with the what, the longest tail, is the rejection block. Look at how IPTA traded this rejection block over here. This should be the upper quadrant. You see, we never came below it. We stayed just above here and even at the open here, and then we saw price take off from here and bought off. So rejection blocks are traded or treated the same as what, fair value gaps. Okay, you can consider rejection blocks as fair value gaps. Go to the chart, look at every turning point. This is a rejection block here. Look at this. This is a rejection block. It took liquidity below this low here. Okay, and then 1, 2, 3. This middle candle with the longest tail is your rejection block. Look at how IPTA respect the upper quadrant of this rejection block, and the body of this candle stayed above its open, and then we saw a massive buy to the upside. I hope you are seeing how these things work out. Even this one right here, 1, 2, 3. This right here also is a rejection block. Okay, this is a rejection block, the lowest candle with the longest tail, and this even makes a lot of sense here. 1, 2 and 3. This is a bullish rejection block. Pardon me, I didn't mean to do that. This is a bullish rejection block right here. This is a bullish rejection block. Now study how price never traded below this rejection block. It just traded to its upper quadrant and it's open, and then we saw this massive buy from there. So rejection blocks are very powerful. Look at how we had a very massive buy. Let's look at the sell scenario as well. This candle right here, 1, 2, 3. This candle with the longest wick in this scenario is a bearish rejection block, and we did not see price even trade right over there again, and price stayed below that. So let's look at more examples, and we are going to end this because I don't want the video to be too long. Now look at this guy here. In chart patterns they refer to this as a pin bar, but it's actually a rejection block. We have 1, 2, 3. This middle candle here with the longest wick is a rejection block, a bearish rejection block in this scenario. So see how IPTA traded to the lower quadrant of that rejection block here. I may not be able to do it correctly. See right here. Okay, and then we saw a massive sell to the downside. So rejection blocks are considered as gaps. IPTA is always going to trade into them to fill them up and then before moving to the opposite direction. Now let us look at the last category of the institutional reference points, which is what the old lows and the old highs. Now for the old lows, an old low is simply an area where price has already traded to. Like this one, this is an old low here, because this is a low that price has not returned to. Okay, this is an old low. We can have single lows and then we can have multiple lows. Okay, we can have single highs and then we can have multiple highs. So in this case, this is a single low down here. Okay, in future IPTA will want to run into that low. Why? Because like we have said already, below an old low we have sell side liquidity. So IPTA in future will want to run this sell side liquidity here and then take price. Or what is sell side liquidity? Sell side liquidity is simply stop losses. Okay, if you bought down here, where will your stop loss be? Right down here, right? There are many people who bought down here and their stop losses are here. So these stop losses are considered what? Sell side liquidity or sell stops. So IPTA will want to run in future into those sell stops before taking price to the opposite direction. So below all lows we always have what? Sell side liquidity or sell stops. Okay, or resting orders or stop orders, and IPTA is always going to run into those lows. Here we have a pool of liquidity. Okay, these are old lows because there are too many lows here, and an area where we have too many lows like this, we refer to that area as what? A pool of liquidity. Okay, it's a liquidity pool. Why? Because there are too many orders there. Okay, there's a pool of stop losses here. Let me do this way. Liquidity pool. Okay, there's a pool of liquidity here. Okay, pool of liquidity, because there are too many stop losses down here. Imagine people who sold here. How many people have orders here? How many stop losses are resting below here? Too many stop losses, right? IPTA does not want to see a lot of stop losses like this because it is too clean. Okay, they want to run it down, take all of those stop losses, and then they will take the market to the opposite direction. Okay, look at this one here. This was a pool of liquidity here. Okay, pool of sell side liquidity. What happened? See how IPTA took price below those lows, cleaned all of these lows. Okay, took all the stop losses here before taking price to the opposite direction. So IPTA is always looking for where there is liquidity, and IPTA is always looking for where there is imbalances. Okay, inefficient price delivery. This is an old low. See how IPTA traded, took liquidity below and then moved to the opposite direction. It took all of this liquidity here. People who bought here and their stop losses here, IPTA took all of those stop losses. This is another old low. See how IPTA pushed price below the old low. People who bought down here, okay, or bought here, right? Bought down here, right? And their stop losses is below here. Look at how IPTA has cleaned all of that. Okay, that is an old low. IPTA is always looking for those old lows to run for liquidity. Even down here, any low where you have a turning point, okay, those are old lows, right? Those are old lows. Even down here, these are old lows, and below those old lows, what do we have? Below these old lows we have sell side liquidity. Below these old lows we have sell side liquidity. Below these old lows here we have sell side liquidity, and IPTA does not like those clean areas. IPTA will trade into those areas to take all of those stop losses. Okay, so what is the function of IPTA again? It always runs for lows or sell side liquidity, and it always runs into areas of inefficient price delivery, which are fair value gaps and the rest. Look at these highs over here. These are old highs. Okay, these are old highs, and above old highs, what do we have? We have buy side liquidity. Okay, where we have buy stops resting above there. People who bought their stop losses is over there. Buy side liquidity. There should be a gap. Yes, there should be a gap like this. Okay, I'm going to position it to the top and then center. Yeah, we have buy side liquidity above here. Look at how IPTA took price up, cleaned all of these lows. Okay, all those who sold over here, all those who sold and their stop losses was above here, IPTA cleans all of those stop losses and does what? And takes the market into the opposite direction. So IPTA does not like clean highs and IPTA does not like clean lows. And always know that above old highs we have buy side liquidity, and below old lows we have sell side liquidity. These are equally old lows. IPTA ran into those old lows took all the sell stops above here. People who sold here and shifted their stop loss here, right? They have stop loss resting above here. IPTA is going to clean them with all of this move here and then take the market to the opposite direction. And what did I just say? In an area where we have a lot of liquidity like this, a lot of highs, a lot of lows, what do we have there? We have a liquidity pool resting here because there's a pool of liquidity here. A lot of stop losses are here. People are seeing this as what? As resistance, okay? And they are selling a lot. And where are they putting their stop losses? Definitely, if you sold here, where will your stop loss be? Above here, right? Imagine how many people in the world are selling over here. Now look at what they will do. They will send price up, clean all of these lows, okay? With this move here, they will clean all of these lows, all of these highs, sorry, they will clean it up, okay? Take all your stop losses and then push the market to the opposite direction. That's exactly what IPTA does. So IPTA does not like clean highs and IPTA does not like clean lows, okay? Above old highs, if you have too many stop losses, it is called a liquidity pool. Below old lows, if you have too many stop losses, it is going to act as a liquidity pool, and IPTA is always going to draw into those areas to clean them up before taking price to the opposite direction. So this is an old low. These are old lows that have what? Sell side liquidity, okay? Sell side liquidity. I'm going to do a different video on liquidity, okay? I'm going to explain the full meaning of sell side liquidity and buy side liquidity, okay? This is sell side, okay? Sell side liquidity where we have stop losses, sell stops, okay? And IPTA is going to trade down into those sell stops, clean them up. It is going to clean all of those stop losses below here because it doesn't want to see clean lows, okay? It will clean them up like this. Take all your stop losses down here. Those who bought here, a lot of people are buying here because they are seeing this place as well as a support level, okay? Now it is thought that we should always buy a support, right? But IPTA trades against that ideology. That's why support and resistances do not work in smart money concept. It's going to trade below because IPTA is always looking for those lows that are too clean or those highs that are too clean. It's going to clean them up and then it will take the market to the opposite direction. I'm going to teach you why IPTA trades below old lows and why IPTA trades above old highs before moving the market to the opposite direction. There's a detailed video I will do on that. But for the sake of this mentorship, just know that old lows are lows that price has already traded into and then revert from. You can have a single low and you can have multiple lows. And if you have multiple lows, then there's a pool of sell side liquidity resting there. If you have multiple highs, okay, then there's a pool of what? Buy side liquidity resting that level. So we have a liquidity pool, a buy side liquidity pool and sell side liquidity pool. I hope you understand what an old low is or what old lows are and how IPTA treats them. These are old lows, okay, and below these old lows, what do we have? We have a pool of sell side liquidity. This is a single low here, right? This is a single low. You will see it as a support, but IPTA will push price below here, okay, clean this low, sell side liquidity, and then aggressively move price to the opposite direction. That's why sometimes when you take a trade, you see the market will just come down, stop you out, and then move in your direction, and you'll be wondering, is somebody actually manipulating the market? No, that's how IPTA always operates because IPTA is always looking for liquidity. See, this is an old high or old highs. What happened? IPTA takes price above it, cleans this liquidity above here. Those who bought over, sold over here, their stop loss is here. They will clean it up and then take the market to the opposite direction. This is how IPTA functions, okay? Now look at this other one also. You can go on and on and on and on. This is an old high, okay, or old highs that has what? Buy side liquidity. When you see this, always label it buy side liquidity above an old high or old highs. They label it buy side liquidity, and above this buy side liquidity, if you have too many highs, what is written here? A pool of buy side liquidity, okay, a pool of buy stops. Now what do we have here also? We have sell side liquidity, and if you extend it across, you see that IPTA traded into these lows in future. No matter how long it's going to take, you see IPTA is always going to refer back to those lows in future. You see all those who bought down here with their stop losses, even those who bought and trade their stop losses inside here, IPTA is going to take price down and clean all of those stop losses before taking price to the opposite direction. So if you study the chart, you see how many times IPTA is running on liquidity. See, these are old lows here, okay? See how they clean those old lows here and then take price to the opposite direction. This is also an old low, okay? So lows, old lows and old highs are always draws on liquidity. When I say draws on liquidity, I mean there are areas that are like there's like a magnet there where price is going to draw to to clean those areas. The job of IPTA is to clean those areas where there's buy side liquidity and sell side liquidity. Look at this one here. You will see this as what? As a resistance, right? And you think when price comes here, you are going to sell because it's a resistance. They will take the market up, take all your stop losses, okay? Clean all your stop losses, and then in future they will take price down. That's the job of IPTA. And what did I say? Above all of these highs here is what? It's a pool of buy side liquidity. So IPTA does not like clean highs and IPTA does not like clean lows. They will always want to clean those lows before taking price to the opposite direction. So this sums up the 7 institutional reference points, which are what? The mitigation block, bearish and bullish; the breaker block, bearish and bullish; the liquidity void, bearish and bullish, which is either a CB or a BC; the fair value gap, bearish and bullish fair value gap; the order block, okay, bearish and bullish order block; the rejection block; and then old highs and old lows. I hope we have covered all the 7 institutional reference points, and I trust that you understand how they function. And from now henceforth, we are going to learn how we can apply all of this in the market. Look at this. These are old highs. You see how IPTA trades above them, cleans these highs, okay? Buy side liquidity. It cleans all of these highs here and then moves price downward. Cleans it over again and then moves price downward, okay? So the job of IPTA is what? To trade into areas of inefficient price delivery and to run for liquidity, buy side liquidity and sell side liquidity. Thank you so much for listening. I trust that you are going to practice this and we are going to meet in class. Thank you so much. Look at here. Those who saw this as a resistance, you see IPTA is trading above. It has taken all the buy side liquidity above here, right? So buy side has been raided. They have taken price up. All those who sold here, okay, they have wiped them off from the market. That's the job of IPTA. Look at this other level again. This is a recent price action. Those who saw this as a resistance and they are selling, what has IPTA done? IPTA is running into them, okay? They are taking all their stop losses away, okay? You see, they will take all their stop losses away and then they will take the market to the opposite direction. Those who saw this as what? As a support level. These are old lows, right? Those who saw this as a support level, look at what they are doing now. They are running all of those their sell stops here. They are running it down, okay? They are running it down. Now there's also what we call diagonal liquidity. I was almost forgetting this, which is like a trend line liquidity or a trend line phantom. This occurs when somebody who bought here and price started moving up, they shifted their stop loss. So this is diagonal liquidity. Now look at how they are running all of that liquidity. Here we have old lows, okay, diagonal old lows, okay, where there's liquidity here or phantom trend line. IPTA is going to clean all of that. That's the job of IPTA. Even here, if we have something like this, even here, for those who trade trend lines, pardon me, my chart is messy already, but I hope you understand what I'm explaining. Even here, okay, there's a trend line liquidity here, a pool of liquidity. IPTA is going to, because people who sold here, some of them are shifting their stop losses here, especially the last institutions. They are shifting their stop loss because they want to see price go further. IPTA knows that the stop losses are both here, okay, trend line stop loss or phantom trend line. IPTA is going to run into all of those stop losses and clean all of that area. This is diagonal liquidity. They are going to clean all of this area here, take all of those stop losses, okay? That's the job of IPTA. Thank you so much again for listening and be safe. Thank you.